in the month of March. It is noteworthy to mention that Russian oil exports have reached an impressive volume of 8.1 million barrels per day, according to the latest monthly report issued by the International Energy Agency. This impressive volume marks the highest level since April 2020. It is interesting to note that despite the dual pressure of sanctions from both the United States and Europe, and the country's own policy of production cuts, the scale of Russian oil exports has quietly returned to pre-Russia-Ukraine conflict levels. It is natural to wonder who are the buyers of Russian oil. Since last year, Russian oil has become increasingly attractive to buyers due to its discounted price compared to the Western price cap. With the gradual disclosure of import and export data, some of Russia's mystery buyers have begun to emerge. China and India, in particular, stand out as the largest purchasers of Russian oil. Interestingly, traders' calculations indicate that India and China are buying oil at prices higher than the Western price cap, indicating that Russia is still making substantial profits. In contrast, the Western price cap on oil has had little impact on Russian oil exports, with Europe now facing an energy crisis as a result. Given the above, it is of utmost importance to delve deeper into China and India's strategic plan to counter Western sanctions, which experts believe will be a game changer. Therefore, in this video, we will take a closer look at the most current news and advancements in world affairs, international relations, and technology. The EU's recent ban on Russia's export of oil products has caused Russia to become unhappy, and in response, Moscow has decided to cut its crude oil production by 500,000 barrels per day starting in March, which equates to around 5% of its total volume. Some analysts predict that these new restrictions will be more difficult to overcome than previous ones since it is harder to find new markets for oil products than for crude oil. While countries like China and India can process crude oil themselves and make a profit, oil products are more complicated. Moscow has made it clear that it will not do business with any country that includes the G7 price limit in its deals. The Economist Intelligence Unit predicts that if sanctions persist, two separate global oil markets will exist. One market will have inexpensive Russian oil, which countries like China and India will utilize, while the other market will not have any Russian oil. However, despite selling more oil to Asia, Russia earned 50% less money from oil and gas in 2022 than in the previous year. Furthermore, Moscow had to sell off its foreign currency to compensate for the loss. Thomas O'Donnell, an instructor at the Free University of Berlin, believes that the new price cap system and logistical difficulties may result in a drop in oil prices and revenue. He noted that after the first year of high oil and gas prices, Russia recovered from the restrictions on selling its oil. Nevertheless, the EU, G7, and the US may apply more pressure on Russia now, and Russia anticipates a decrease in its oil and gas revenues this year, which means it must find new sources of income. Experts also predict that China and India will have a robust demand for Russian energy in 2023, with Chinese buyers being more interested in Russian crude than Indian buyers. If Russian distillate exports face difficulties finding new markets following the EU's ban on Russian products, and Russian refiners must reduce crude runs, Russian crude exports may need to increase. Finally, opinions are divided on the efficacy of the price cap on Russian oil exports, which was imposed by the G7 countries in an attempt to reduce revenues for Russia and compel it to cease its activities in Ukraine. Data from Refinitiv Icon reveals that most of the Russian Euro oil cargoes loaded in April went to India and China, with India receiving over 70% of the oil and China approximately 20%. The Western countries have threatened sanctions against traders who assist in purchasing oil above the cap, but India and China did not formally commit to following the price cap. This has caused a high degree of perplexity in the market, as Western countries are concerned about the effects of these actions. Despite these threats, Russia's oil prices remain significantly lower than those of other producers due to international sanctions, which have had a substantial impact on Russia's economy. Reports indicate that Euro's crude oil typically receives a discount of $13 per barrel when shipped to Indian ports and $9 per barrel when shipped to Chinese ports on a delivered ex-ship basis. Moreover, shipping costs for loading from Baltic ports to India and China are $10, $50 and $14 per barrel, respectively. The recent improvement in Russian port ice conditions and the increased availability of tankers have led to a burst in shipping costs. For example, the cost of shipping Euro cargoes from Baltic ports to India has decreased from $8 million to $1 million to $7.50 to $7.60 million, while the cost of transporting these cargoes from Baltic ports to China has dropped from almost $11 million to $10 million. In April, the OPEC Plus group announced output cuts causing prices for various types of oil such as euros to rise globally. Nevertheless, despite Western sanctions, Russia's economy has been doing well, thanks to China and India's high demand for Russian energy. India has become Russia's largest customer, importing a record 1.4 million barrels per day in January 2023, and China has become Russia's second largest supplier of crude oil. However, Indian Prime Minister Narendra Modi is facing a challenging decision as he navigates high inflation and an upcoming election year. While he maintains a good relationship with Russia, he has also strengthened ties with Western countries, and analysts speculate that he may be tempted by cheap energy imports from other countries. Turkey has already become a major buyer of Russian crude oil and coal, and analysts predict that Pakistan and Bangladesh will soon follow suit and increase their imports of Russian energy at lower prices. Furthermore, Russia has created a shadow fleet of nearly 600 old oil tankers to circumvent Western sanctions following the lead of Iran, which is heavily sanctioned. According to Bloomberg, there has been a recent increase in demand for oil storage tanks in Singapore, indicating that Russian fuel is being mixed with other oil and re-exported to make it harder to trace. Despite this, oil and coal exports have remained close to pre-sanction levels. In summary, while the G7 price cap may not have achieved its intended goal, Russia's energy exports continue to thrive thanks to strong demand from China and India. Whether this trend will continue remains to be seen. But for now, Russia's oil producers appear to have found a way to circumvent Western countries' sanctions, leading to a high degree of burstiness in the energy market. Express your thoughts by leaving a comment in the section below. We appreciate you for sticking with us until the end of this video. Before you leave, please show your support by giving us a thumbs up and subscribing to our channel. Don't forget to hit the notification bell to stay updated with our latest videos. We look forward to seeing you again for more captivating content in the future.